Hey guys, welcome to the Directors Report for the start of spring. Both Mark and I have been in a pretty healthy paddock, as you can see, during winter.
I don't think that's the first time you've mentioned that on one of these directors' cuts.
No, at one
Seems
point,
to be a bit of a recurring theme. But anyway.
At one point in time, we'll come back nice, fighting fit.
Yep.
There's been a lot going on over the winter break. More importantly, a lot of questions regarding interest rates. As you can see, the Reserve Bank has been really active over the last 5 months. But more importantly, the question we're getting from our clients, the question we're getting from our business partners is, how low can they go, mate? What do you think?
I just don't know. Like I read this article about one of the best answers that the boss of Google gave in a job interview once, and the best answer he could give was, I don't know, because he didn't know the answer to the question. We don't know. What we would say is it's at 0.75 at the moment. It's reduced 3 times, so it's reduced by 0.75 in the last 5 months. And the people who've got access to more data than you and I and study this stuff closer than you and I are suggesting that there's still more to come.
Yeah, they don't know. There's leading experts in this market changing their mind off the back of data that's been released all the time, and their guess is as good as ours.
Yeah. Some would say their guess is better than ours. But yeah, to answer, we don't know. All we know is they're really low, and it's possible they're going to get lower. So what we'd love to cover off, I suppose, today is what we do know, and some of the decisions or the questions that you guys, as our clients, would have. Okay,
so let's start with, there's 4 key things that we do know.
Yep.
And 4 key things that are largely fact. Let's summarise those for you. As you just mentioned then, we do know that the RBA has reduced their cash rate 3 times since June. So 3 times over the last 5 months. What we also do know is that the banks have not passed that on to you, the consumer, in all the instances. So on average, about 90% of the banks have passed on between about 0.55 and 0.6. And they all sort of land within that
0.05.
Within that sort of range.
So despite the marketing and the noise, majority of them don't move too much different from each other.
Some move more than others in isolation, but over the average of 3 rate reductions was a pretty good sample size. They've all landed within about 0.05% of a reduction. What does that mean to you guys on a $400,000 mortgage?
Which is pretty much the average, I think. It is in Melbourne in particular, but Australia-wide.
Pretty reflective of our client base as well. That actually means the best part of about $2,500 worth of interest savings to you guys. So that's the first thing that we know. The second thing that we know, that as we touched on in our last director's report, was that qualifying for finance has become a little bit easier with assessment rates coming down. So we're finding that people are able to borrow a little bit more now than they were able to borrow the best part of 6 to 12 months ago. They're 2 things we know. What are the other 2, mate?
Property prices in the Sydney and Melbourne market that obviously have seen the most significant growth over the last 5 years, also saw the most significant reductions over the last sort of 12 months. So those 2 particular markets, they're the primary markets in Australia. We've seen them rebound the quickest, which is probably not surprising. So we are seeing clearance rates as well increase significantly over the last sort of 2 to 3 months. And we're also seeing fixed rates continue to come down as well too. So you'll see on average across, whether it be investor or whether it be owner-occupied rates, principal and interest or interest only, you'll find that on average fixed rates, in particular if you use the 3-year fixed rate, which is the most common interest rate or fixed rates taken out, it sits around about 0.3 below the average variable rate.
Okay.
So that just tells you at the end of the day that lenders are doing 2 things. They think that interest rates are still going to come down, and they're also trying to grab some market share and get some borrowers and lock them in for a little period of time. So they're wanting to buy some borrowers on cheap rates.
So they're the things we do know. So what do those things mean?
There's a
for
5th
these
one,
guys?
that it's not that easy for us to continue to sucking our guts in for the next sort of 2 or 3 minutes.
Let's wrap this up.
We know that as well.
Let's wrap this up, so I'm going blue. More importantly, what do these changes mean for these guys, for our clients?
So the decisions, I suppose, the emails that we're getting, the phone calls that we're getting are centred on probably 2 or 3 main questions. The first ones are, they're seeing fixed interest rates. You, our clients, are seeing fixed interest rates. Quite a few of them have got a 2 in front of it. So you would understand, you sit there and go, wow, I want a piece of that. So if you think about what we just spoke about before, if the banks, what we would suggest is that the banks are going to continue to do what they've been doing previously, meaning they're not going to pass all of the interest rate cuts on. If fixed rates are sitting around about 0.3 to 0.4 below variable rates, in essence what they're saying is they think that there's probably going to be another 2 variable rate reductions. So the cash rate will come from 0.75 down to 0.25. So another 2 interest rate reductions, and about, again, 70% of that passing on. So if you're sitting there saying, okay, should I fix my interest rate or not? We always say it just comes back to, do you want some certainty? But if you're sitting there, there's really, I suppose, a compelling argument to turn and go, well, if the Reserve Bank reduces their interest rates another 2 times, that money's being offered to me now as a fixed interest rate. There is some merit associated with considering fixing some.
Typically, there's some restrictions with fixed interest rates and product providers.
And paying extra in.
Yep. Paying extra in, and more importantly, the cost associated with if fixing isn't suitable for you.
Yes.
So they're decisions you can't make based off the rate only. You need to speak to someone regarding the advice and if it's suitable for you, that type of product. But there is an option that we have access to.
Yeah, so we've also got a special loan product that at the end of the day gives you not only the certainty associated with a fixed interest rate, but also the capacity to pay as much extra as you want into the loan and not lose access to those funds. So there's no restriction on your ability to not only smash your debt down and reduce the amount of interest you have to pay, but also get the certainty associated with interest rates. So give us a call to discuss that.
And the lower rates that fixed rates are offering now comparative to variable rates.
Yep, so it's something to definitely think about.
Okay, that's the first.
So
that's
fixing
the first
or not? Yep.
Second question is, what should I do with the funds that I've now got access to because of the lower interest rate? So one of the options is you can maintain the current repayments that you're making prior to these reductions. So let's use what we discussed before. 0.6 is the standard rate reduction that funders have provided to clients.
Yeah, over the last 6 months.
Over the last 6 months, and using $400,000 as an average loan balance. So the actual savings in terms of repayments, or the reduction in repayments that people have had using those two variables, is about $135 per month.
Yeah, so if someone's had a $400,000 loan, their repayments reduced by about $135
off the back of the last 3 rate reductions.
So what do they do with that $135, Chris?
They can continue to pay off their mortgage.
Put that one, keep paying at that level.
Keep paying at that level. Yep. What does that mean for you guys? If you
why would you do that?
Well, one, you would reduce your interest payable over the life of the loan. And I suppose if you look at it from a 30-year loan term point of view, what you'll ultimately save over that 30-year period is about $30,000 in interest. No small savings.
By reducing the term of the loan.
By reducing the term of the loan by about 3.5 to 4 years. So your ultimate savings is about $30,000 over a 26-year loan term because it's reduced by 4 years.
So you'd save $30,000, but you'd save that $30,000 over a 26-year period, right?
Yep. So a bit over $1,000 a year. Yep, that's one option.
Yep.
And that's one option that you can start doing now. What's the other option? The other option is you can use those funds to invest somewhere else, or to contribute those funds to another investment option as opposed to reducing your mortgage.
Which is what you're seeing a lot of people do, where you talk about the property prices increasing. If we were just to say, I'll take you through an example now and just focus on investors and what they're seeing and the decision that they're making, because ultimately they're turning around and going, well, I've got $135 that I can save. I've got extra. I can save myself 3.5% interest on that.
Yep.
Doesn't necessarily excite me, not as $30,000 over 26 years. What can I make if I actually divert that money to something else?
And this depends on your risk appetite for investment. So let me go mobile. I'm going to move this over so we can see these numbers. I've gone all Blair Witch Project on.
Okay, I'm just going to take you through a quick example. I'm going to use a property price of $800,000. Why? Because that's the median property price for houses here in Melbourne. So I'm just going to use that, just like we use the average loan size of $400,000.
Yep.
On an owner-occupied mortgage. Interest rate. Okay, so I'm just going to use flat figures here. This is around about the mark. So 4%, you can borrow 4% interest only, variable interest rate. Okay, I can get a rental return of around about 3% on average. Okay, the difference between the two is 1%. So that's the shortfall that I've got to fund, right, on a monthly basis. 1%, what does that mean on $800,000? It's $8,000 per annum. So the decision they're sitting there thinking, okay, well, I've got to fund. Can I, as a borrower, fund $8,000 per annum? It's not just that cost though. There's also $2,000 I'll use as an example per annum for rates and ancillary sort of costs associated with it. So the total costs of holding this $800,000 property comes to $10,000 per annum. Now, Liberals got in, negative gearing remained. So what I'm talking about here is this tax benefit. I'm going to put a tax benefit there of about $4,000. It equates to around about 40%, and I'm using that because that's the approximate marginal rate for someone would be on their tax rate, and they would need to be earning about 90 grand or above to consider buying something like this as an investment property and also carry an existing mortgage. So ultimately, I get $4,000 in my tax back. So the actual shortfall and the cost associated with being able to hold this property is $6,000 per annum, or you could call it $500 per month. Why would I go and spend $500 per month on anything? Right, it's still costing me $500 per month. Well, the only reason I'd do it is because if I thought this thing was going up, the property price. Now, I'm not going to use your old double in 7 and 10 years. I'm going to be more conservative and say that the thing goes up by 5% per annum, right, which is more in line with probably an average performing property. What that simply means is that your net wealth goes up by $40,000, right, in any 1 year, using that as an average. Sometimes it's more, sometimes it's less. So I'm going to invest 6 to get 40. Means I'm going to improve my net asset position by about $34,000 in 1 year, as opposed to saving myself, $30,000 over 26 years. Now, does that mean that this is the right decision for everybody? No. Does that turn around and say that reducing your mortgage shouldn't still form some part of your overall strategy? No. But these are the decisions you've got to make, understanding what your risk appetite is, depending upon what stage of life that you're at. And these are all questions that we're here, well, that's the purpose, I suppose, of why we're here, to help you navigate through those and make the best decision for yourself. So please pick up the phone, give us a call when you're weighing through the options that are available to you in this environment, and we'll be more than happy to help.
Thanks, guys.